Greetings, it is time for another monthly inflation update. Inflation is all the rage in the media because short-term inflation has finally spiked up a little bit, and the media is very good at distorting reality, especially on all-pervasive media that now includes social media and 24/7 bombardment of this message. The media is in the business of making you angry or frightened, and therefore the media has persuaded people that A, inflation is a much worse thing than it actually is, unless it's very high inflation, which we don't have, as I will demonstrate through the indisputable data that I'll present in this video. And also that inflation has been high for much longer than it really has been. Inflation has been a little bit high for maybe 3 or 4 months. The media has persuaded a large portion of the population that inflation has been high for 10 years. Even if they didn't think inflation was high 4 months ago, now suddenly they think it has been really high for 10 years or more. So I'm going to debunk all of that in this video over here. Now, as always, we go to the 3 metrics I've chosen to get the most multidimensional assessment of inflation for maximum international measurement, as well as measurement across freely traded items, thereby avoiding accusation that this metric is manipulated to deliberately understate inflation, and I will show you how that narrative is completely false and can be easily debunked. So first is the US CPI, 10-year compound annual growth rate. The second is the Goldman Sachs Commodity Index, also 10-year compound annual growth rate. And the third is the 10-year US Treasury yield. And I choose an unusually low number here, 3%, because for most of the last half century it has been much more than 3%, but now we are in an age of technological deflation, which the market is already pricing in, and it's very hard for this number to get above 3%, even though the Federal Reserve is in fact raising the Fed funds rate, the front end of the yield curve. This is not being pushed higher to maintain a 3% spread in the yield curve, which is normally what correlates to a robust economy. It is resulting in a flat yield curve, indicating that the Federal Reserve is taking the wrong action. And yes, a 10-year window is necessary because people screech about 1-year inflation rates being high, but these same people are nowhere to be found when the 1-year inflation rate is low. And these are people who are more driven by the media narrative of the day rather than any holistic or data-driven assessment. And people who criticize taking a more data-driven and unemotional approach to this whole assessment of whether we are actually in high inflation or not are rather innumerate at this point. I will use that word innumerate to describe them. So for symmetry, I choose 3%, 3%, 3%, and I need all 3 of these numbers to be above 3% before I say that inflation is higher than optimal. If all 3 were exactly 3%, I would actually call that optimal. That is when technological progress is the highest relative to the least amount of pain for the general public. Remember, deflation would be catastrophically bad for the general public, as I explain in this video up here on the right-hand side. A lot of people don't realize that. They think all inflation is bad and all deflation is good, and they couldn't be more wrong, because deflation would lead to massive job losses, far more than slightly above trend inflation. But I require all 3 to be above 3%. This is a very low bar as per 20th century economic realities, but in a technological age, this bar is proving quite difficult to surmount, as we shall soon see. So the first one we'll go to is the US CPI. So this is the bls.gov website. Go to prior month videos to see how I access the inflation chart. And in formatting options, I have chosen 1 month, 2 month, 3 month, and 12 month as metrics that we are going to look at in terms of windows of time. But this is the CPI number itself. Looks pretty scary, seems to be rising exponentially. So what is the 10-year compound annual growth rate? So we take the calculator and we take this number, which is 295, divided by the number exactly 10 years prior, which is 229. 295 divided by 229. So 1.288. So 28.8% is the inflation over 10 years. Now what is that per year? So we take the 10th root of that, which is 0.1. I hope everyone understands the arithmetic of how this works. That's 1.0256. So you minus 1 and multiply by 100, so that's 2.56% average annual growth rate of the CPI, and we round that up to the first decimal, so 2.6%. I do round it up even if that would be slightly unfavorable to my prediction set, because I'm very confident in my entire atom thesis of technological deflation. So 2.6% is the compound annual growth rate of the CPI over the period in question. Now as we go down, this is the 1 month metric. It's already kind of flattening. It rose a lot, but it's not rising at the same steep rate anymore. Same goes for the 2-month. Now 3-month looks like it's steeper because this is the max amount of the gradient. And this is the 1 year. This is what looks really scary, but it rose this fast. It can fall this fast too. And it rose, of course, because the United States made the overt decision to block domestic oil and natural gas production, or at least greatly discourage and inhibit it. And that has caused oil and natural gas to rise for reasons that have nothing to do with quantitative easing, because quantitative easing was going on for 12 years before this, as we all know. So this is the 1 year growth rate that everyone fixates on, but the same people were nowhere to be found over here when we were drifting into deflation, as well as over here when it was zero for well over a year, and how this entire period was kind of low. So the average of all of this going back 10 years, starting from July of 2012 to now, is 2.56% or 2.6%. So that was the first number. Now we go to the next one, Goldman Sachs Commodity Index. Goldman Sachs Commodity Index, the link for this will be in the description box below, of course. 10-year compound annual growth rate, 0.58%, still pretty low, nowhere near 3%. It got rather close to 3% a few months prior, but it just couldn't sustain that much growth, and now it's back down to 0.58%. This number is pretty volatile and can jump around a bit. That's why I insist that all three of those numbers be above 3%. But this is only 0.58%, absolutely nothing to worry about. Commodities are barely avoiding deflation on this 10-year compound annual growth rate measurement. So now we go to the third and final metric, which is the 10-year U.S. Treasury yield. 10-year U.S. Treasury yield, 2.93%, so pretty close to 3%. Last month it was above 3%. You see how difficult it is for this to go above 3%. It peaks above it for a very short while, maybe just a day, and drifts below again. Peaks above and drifts below. This is a pretty hard ceiling, and I predicted this months before it ever rose that high. I started using this metric many months ago over here because I knew 3% is when the difficulty becomes exponential. This is a 2-year chart. Let me take a 5-year chart. See, it was above 3% in 2018, but that too only for a few days. It was not above that for much longer than that. And if one takes a 40-year chart, so 1980 to present, more than 40 years, it has been above 3% for so long that the fact that it's difficult to go above 3% now kind of proves how much technological diffusion there is and how exponential technological deflation is a reality. Even in the 1990s, rates of 6 to 7% were normal. In the 2000s, 4 to 5% was normal. Now it's having a lot of trouble getting above 3%, and that too only because the United States has raised the Fed funds rate and is selling the treasuries that it had bought. So now it is selling treasuries, lowering the price of treasury bonds, and increasing the yield, but still only 2.93%. So now we go back and look at all three of these measurements in tandem. So US CPI 10-year compound annual growth rate, Goldman Sachs Commodity Index 10-year compound annual growth rate, and 10-year US Treasury yield. Today is July 15, 2022. So what are all three numbers now on the same chart? 2.6% for the CPI as we saw, 0.58% for the Goldman Sachs Commodity Index, but this is pretty volatile as we've seen. So it can get close to 3% and fall back down really fast. And 2.93% for the 10-year US Treasury yield. This is having difficulty going above 3% because the difficulty rises exponentially. That's what a lot of people don't understand. That's why I could say with confidence that such a low threshold, a threshold that is much lower than what this yield was for most of the prior 40 years before the age of QE and the age of the atom being large enough to generate an amount of technological deflation that's meaningful to get to 3%. Now it has a lot of trouble breaking 3%. So as we can see, we are quite far from the point at which all three of these numbers are above 3%. Remember, all three have to be above 3%. Not just one of them above 3% or not just the average of them above 3%. All three have to be above 3% because this is an unriggable metric. The Goldman Sachs Commodity Index is a basket of freely traded commodities, oil, natural gas, gold, everything, and therefore cannot be rigged. 10-year US Treasury yield also cannot be rigged because this is freely traded. So we are still far from a point where inflation is high. Inflation is not even optimal. Now, I don't mean to be heartless by saying that, but the short-term inflation spike is exactly that, short-term. It has done very little to move up this 10-year compound annual growth rate, and it is about to fall very quickly because demand destruction and technological adaptation around high oil prices has already manifested, and oil is significantly off its highs. And remember, a deliberate government policy goal of increasing the price of oil and natural gas in order to create more inflation and to reduce the consumption of oil and natural gas is the only reason for this temporary inflation spike. It would not have even occurred if the Biden administration had not stopped domestic oil and natural gas production, and Republicans are culpable in this too, so it's not a partisan thing. They don't seem to be troubled by it, even though this could be seen as one of the best things to happen to the U.S. economy in a lot of years. The Republican Party is not out there defending fracking or anything outside of a small fraction of those politicians. Now, I'm not a fan of a government policy that tries to force demand destruction along at an unnatural pace. They should not have stopped domestic oil and natural gas production because demand destruction of oil was already occurring. Electric vehicles are selling more and more, as evident from a number of videos on this channel. But there's even higher level disruptions like the work from home revolution, where people aren't even commuting anymore, and therefore that gasoline consumption has disappeared entirely. It's not even being replaced by electrical vehicles. Electrical vehicles are only the number 2 disruption. The higher disruption in the hierarchy is the Zoom video conferencing telework revolution. And that is also very deflationary. Deflationary towards oil prices, deflationary towards the number of cars that sells, so the percentage of household income that goes into automobiles, and deflationary towards real estate, as I speak about in many videos on this channel. So no, inflation is not high. This CPI number, it takes a lot to move it high, but also takes a lot to move it down. So this is chosen quite fairly, I would say. This is edging up towards 3%. And if it gets to 3%, still has a long way to go, then it'll take a lot to make it lower. But then you have these two as well, which are freely traded, and the narrative of the inflation measurements being rigged just cannot possibly apply when these numbers are in fact so low and have been for such a long time. So this was the monthly inflation update for July of 2022 with the most recent numbers available on this date. Now, if you found this video to be informative and a welcome intervention of reality against the media narrative that is designed to frighten people in all dimensions, the extent of inflation and how long it's been high, then I encourage you to subscribe to this channel, and thank you very much for watching.